I'm Jay Tipton from Gordian Strategies, and we're back with one more ep of Untangling Climate Finance. In this episode, I connect with Chris Slater, the CEO and co-founder of Oka, the carbon insurance company, which is a firm working at the intersection of carbon markets, insurance, and climate finance. As carbon markets grow in complexity and scale, risk remains one of the biggest barriers to financing climate projects. Developers face delivery risk, lenders face credit risk, and buyers worry about the integrity and permanence of the credits they purchase. That's where carbon credit insurance comes in, a fast-evolving space designed to de-risk these markets and unlock capital. Oka is one of the first dedicated carbon insurers in the world. Their mission is to make carbon finance more secure, more bankable, and ultimately more scalable. And they're doing that by building a new suite of insurance products that support project developers, investors, banks, and impact funds alike. Chris brings deep expertise in insurance and entrepreneurship, having built and exited one of the largest digital insurers in the UK before turning his focus to climate. With Oka, he's applying lessons from traditional finance to solve some of the carbon market's most persistent problems. We talk about the evolution of Oka's products, how insurance is helping structure carbon deals, and why project developers are often the ones carrying the most risk. We also dive into how Oka is working with banks and impact funds to unlock finance for climate projects around the world, especially in underserved markets. We also talk about trust, risk, and why perfection shouldn't be the enemy of progress when it comes to scaling climate finance. So, let's hear from Chris. Hey, Chris, welcome to Untangling Climate Finance. How you doing?
I'm good, Jay. Great to be here.
Where are you calling in from today?
I am calling in from rather sunny Manchester in the UK. Sort of returned home after a number of years away. So just back after dropping the kids off at school.
There you go, back in sunny Manchester.
Exactly.
Great. Well, as I always lead the episodes off, it would be great to hear about yourself. So why don't you tell me where you're from, your career path, and then how you found yourself in the climate change/insurance space?
Yeah, I'm an insurance guy, so I sort of start out with that. But if I take it all the way back to where I came from, I was originally from Manchester. I'm from a sort of family of builders and engineers. My father's in engineering, my grandfather before him. And, I think from my early years, what I realized was I love building things. I love solving problems. I love building, in my case, building businesses. So very early on, sort of entrepreneurial itch, and I ended up in insurance, and I ended up co-founding a business called Simply Business here in the UK, which we grew to be the largest provider of online small commercial insurance, helping other builders, restaurants, pubs really get their insurance, but do it in a digital way. So this was 2004, 2005, the onset of the internet, post-internet boom. And interestingly, I sort of relate some of those early days to some of what we're trying to do here at Oka. I had a thesis that the market would develop and everyone would move from offline to online. And actually, it took 7 or 8 years, and we had to navigate choppy waters whilst we built the business. But I spent, it was almost 15 years building that business to be the most, it's the largest here in the UK. We've helped 1 million customers sort of arrange their insurance needs. And I took it over to the US for a sort of new adventure, lived out on the East Coast for a few years. And really, when I sold that business in 2017, I sort of looked around at, where could insurance play a role in helping another market scale? And I sort of got pulled into, climate quite late. Moved to driving an EV. I'd stopped eating beef. I was doing, and I sort of had my early kids, and I sort of gravitated, as you do as a new parent, towards, okay, well, what's the future we want to build for our kids? And I sort of got pulled into climate in the broadest sense, and then started to look at, okay, how could insurance play a role in helping in this climate transition? So I looked at clean energy, looked at renewables. And then interestingly, my co-founder had a carbon credit contract come across his desk. Our chairman here at Oka owns properties on an estate in Oxford. And he said, you know anything about a carbon market? I was like, I knew absolutely nothing. So this was sort of 2022, 2023. And as I started to peel away the various different layers of voluntary carbon market, how it had been born, various compliance markets that existed, and started to look at carbon credits and why people were buying credits, who were buying credits on a voluntary basis, I got really excited, Jay, by, okay, you've got a clear way of directing finance and capital into solving one of humanity's biggest problems. And you had at the time corporations really leaning into that, 2022 into 23 this was. And what was interesting was as I spoke to buyers of credits, as I spoke to developers, I spoke to large trading desks, everyone was talking about risk. Everyone was talking about how do we help reduce the risk in these projects? And then that sort of just sparked an idea around, okay, well, how insurance has the 300 years helped solve some of those risk problems. So why do we go about building a business? And that's Oka.
There you go. And your intuition and market understanding were right on the money, because the concept of insurance in this space is relatively new, as I'm sure you know. And so there was without a doubt a gap there that needed to be filled, and risk was and still is one of the biggest buzzwords in the carbon space, without a doubt.
Yeah, absolutely. And as any entrepreneur coming into a market, you get a few things right, you get quite a few things wrong. And your skill is to take those lessons and build off the back of that. I think two things actually I believed as I came into the market in 2023 was, one was that sophisticated understanding of risk, which I thought there was an awareness through those conversations. And whilst there was an awareness, I think the technical understanding of where risk sat, who bore the risk, who was willing to offload that risk, was much further behind than I expected. And really the last 3 years, along with a number of our peers, has been about sort of educating the market. So that was one thing. Mm-hmm. And then the sort of second thesis I had was that the risks were really borne by corporates. And my original thesis was that, well, let us help corporations. I'm very focused on the US actually, with climate disclosure bills, SEC bills being posted. I was like, okay, well, this is interesting. There's going to be an awakening of risk moving from sustainability into finance, because CFOs are now going to have to sign off on climate disclosures, and these carbon credits that they're buying is now an asset that they've bought, invested in, and there's no risk mitigation. So why don't we put some risk solutions in play that really help take some of that risk off the table and really make organizations and corporations more comfortable to buy credit? But what I got wrong there, Jay, is that actually, as I got into the market, well, two things happened. One, corporations stopped buying credit, so couldn't control that. And you have a conversation around what the future looks like on that basis. But the second thing I got wrong was that actually much of the risk gets pushed down to project developers. Yeah. So whether it's corporations going face to face, looking to invest in a project, whether they're buying credits on a spot basis to be able to meet some voluntary commitments that they'd made, or indeed even the standards bodies, if something happens on a project, really they look to the project developers to make good rather than to the corporates. The corporates are almost protected, certainly in the voluntary market, from any of these issues or try and pushing these issues down to developers. So we had to pivot as we came into market 2023 and really start to think about how do we support project developers.
And so, you took all these very smart theses and your market understanding, and you said, all right, let's build Oka Insurance. So why don't you tell me what it is and how does Oka differentiate its insurance offerings compared to others in the space? And also, is there a meaning behind the word Oka?
Yeah, good question. Yeah, it gets pronounced a number of different ways. Oka. It's actually a Brazilian term. It comes from one of the Amazonian original languages, Tupi-Guarani, which actually means, Oka means home. And we felt it was quite fitting in terms of, look, we're trying to protect through our insurance solutions, the home, which is our planet. So yeah, and Oka really, we're a dedicated carbon insurer. So what I try to stress to people is that how we're different to other participants in the market is that we actually bear the risk. So we don't go and source products from other insurers. We've actually I put the capital together to give us the flexibility to build the products ourselves. So we price the products, we put the policies together, we structure the policies, and we put the capital together, which means that we pay the claims ultimately as well. And fundamentally, Jay, what does that mean? Well, that means that we can tailor our products really to the problem that we're trying to solve. And I'll come back to that through this conversation that, back to my sort of engineering roots, really what we're trying to do is find risk problems and solve them with insurance. And in a new, nascent, global, diverse and ever-changing market, that flexibility to tailor and iterate those products is really fundamental to our scale to date. I talked about getting our thesis wrong on day one. Well, our ability through putting our own capital together is that we can then change tack pretty quickly. Now, with that, we're a Lloyd's syndicate. So we sit within a fairly unique insurance mechanism within the global insurance market, which Lloyd's is a marketplace of, I think it's 95 syndicates, which all contribute capital into a central fund. What does that mean? Well, if I get things wrong and I can't pay the claims because I've not put enough capital up, you've then got a central fund, billions of dollars for those 95 syndicates. And fundamentally what that means is that we can provide our products in A-rated paper, one. So there's a security there that you get dealing with a large global insurer like a Chubb or like a Zurich or like a Swiss Re. That Lloyd's name is fundamental on that rating. And the second thing is it gives you a global license. So I can write business into 130 countries globally through the passporting that Lloyd's gives me. And then the third thing, and what's been really interesting, and maybe we'll come onto it later as well, is because I'm part of this group of 96 syndicates, I can actually build capital and support for projects through other syndicates backing me. Why is that important? Well, if you look at some of the projects in the carbon market, the risks that exist go into the hundreds of millions of dollars. And therefore, as a new business and as a new syndicate, I can take some of that risk, but very easily then be able to layer in additional capacity behind that allows us to really take a lot of that risk, which is where we need to get to for the insurance industry to play its role and really bring institutional capital into the market. It needs to be able to take some of those big risks off the table.
And you have some products, and we'll run through them and you can kind of break them down, but you have developed products like your prepayment protect, your delivery shortfall protect, non-payment protect. Can you walk me through these and explain how they address certain gaps in the market?
Yeah, I mean, I'll sort of start, Jay, with really where we've tried to build our insurance products is how do we sort of do a reallocation of risk to enable capital deployment? So what does that mean? Well, if we look at ultimately where risk is being pushed down to, so project developers, we're trying to help them do two things. We're trying to help them sell more credits, or we're trying to help them raise finance. Now, to do that, if we look at the first point, looking, how do you sell credits? Well, many of the contracts with project developers are for forward issue of credits, and they're based on a delivery schedule over a period of time.
Mm-hmm.
And those two products you mentioned, either investors or off-takers are prepaying off the back of that, or they're paying on delivery. And what happens there is that the risks appear within contracts very differently. So if you're a prepayment off-taker signing up and really getting a firm commitment of credits over the next 10 years from a reforestation project, what are you looking for as an off-taker? Well, you're looking for security around, we're paying up front a capital amount to ensure that we get these credits. We want to make sure we get those credits. And what happens if those credits aren't delivered? They look to the developer to make sure that there are mechanisms in place that allows them to get those credits. And they come to us as an investor to say, well, what happens if this project developer goes under? What happens if there's a catastrophic climate event that means that the project can't continue? So we put a product around really to help try and take some of that risk and enable that investor to feel more confident of putting that offtake contract together. But also, we know in the market, and there's been a trend towards less of the prepayment, maybe more on a pay on delivery. because of some of the risks that exist in the market.
Mm-hmm.
And what we started to see in those contract negotiations is from buyer and seller, so from off-taker or contractor with the developer, is that they're starting to mature the contracts and the penalties that appear within those contracts if something happens. So if I look at contracts from 3 or 4 years ago, it would have been written on 2 pages, and between buyer and seller, they would have figured it out. If the credits didn't get delivered, they sort of accepted, well, they'd sit down and maybe they'd reschedule or they'd recontract, but there's no loss necessarily from a financial perspective because the buyer hasn't paid anything. But now the reputational risk, the time and diligence that they're putting into these contracts, the fact that they're getting these projects rated, there's financial and time commitments from those buyers. And what they're starting to do is bring in contracts from other power purchasing agreements, from other purchasing of renewables, for example. Those contracts are starting to get more sophisticated, Jay. And what we're starting to see is a sort of waterfall effect of, okay, you as a developer have not hit this delivery. What happens next? Well, we'll give you another 12 months to make good in the next delivery. Okay, that delivery isn't met. Okay, well, we'll give you a long stop of another 6 months. And if credits are still not delivered, then we need damages, liquidated damages or some sort of penalty. As well as that, we want to see you as a developer potentially go and get a letter of credit so that if you go under, we as a buyer, as a sophisticated buyer, have recourse. And that's really where insurance can play a role. We can come in there and go, well, under these scenarios, we can attach our insurance and really provide the protected mechanisms that really wraps that project developer almost like a bond. And I use the example of the construction market because it's something we all potentially know well on the insurance side, is that if you're putting a construction project together for a power plant or for a large hotel, a developer will not get a contract to work on that project unless they're bonded, unless they've got an insurance product that provides downside protection that if they go out of business, run away with the money, and fail to deliver on the project on time, then effectively the investor or the financier can basically have recourse and can continue that project or can go and seek other construction firms to come and complete that project. We're just lifting those same mechanisms and bringing that into the carbon world. And I think what's exciting, Jay, is that sophistication of contract negotiations, of project structuring is starting to mature, and we're seeing a way of insurance being able to unlock that. So that's all on the sort of, I'm a buyer of the credits, I want the credits, and you as a developer are having to put some mechanisms and some protections in place to help out. I deal with the sort of final piece, which is an exciting place that we've really helped over the last 12 months, is we help project developers not only sell credits, but we also help them raise capital. And what do we need in the market? Well, we need the very best projects to be scaling. But the challenge that they've got is that they're projects that are located in jurisdictions that financiers are uncomfortable with. They don't have collateral that an investor can take hold of. If something goes wrong, the only thing typically the projects have are their carbon credits. You've got an unstable market with an inability to build a pricing curve that gives security for an investor and a financier to be able to provide typical debt structures in. So with all of those challenges, Jay, if I'm a project developer looking to go to an institutional bank to say, you know what, I've been running projects for the last 10 years. I really want to expand projects into a new country or a new site for my biochar facility. The difficulty that they're facing is that when that investor, that bank goes to the credit committee, well, it hasn't got collateral. It's not in a jurisdiction we're comfortable with. There's no market for carbon credits that we can see. They just can't raise the capital to help them scale. So what we've been able to deliver is this non-payment product. And it's, again, very atypical within structured finance that insurance balance sheet sits alongside a bank's balance sheet, and the bank doesn't have to take all the risk. We can lean in and syndicate some of that risk onto ourselves. And we've done a couple of those deals already this year where a bank has looked at a project. If I use an example of a developer in Africa, large African bank, deal wouldn't have got through their credit committee without an ability to syndicate at least 40% of the risk. So we were able to work alongside them, diligence the project, get comfortable with the risk, sit alongside them, and they were able to put a $15 million facility into this developer, which now is allowing them working capital to help them scale a project. That's wonderful from a carbon market perspective, because you're starting to see these sophisticated structured finance solutions with bank balance sheets, insurance balance sheets really working together, unlocking that capital and reallocating the risk so we can help it scale.
Yeah, that's very encouraging, obviously. I think that it speaks a lot to their desire to improve the sophistication in terms of like strengthening the deal itself. Real quick, just for clarification and comprehensiveness, I'm going to play this back and tell me if it's correct, because I want to review the three protections that we just discussed. So for the prepayment, the insured would be the investor. For the delivery shortfall protection, the insured would be either the credit buyer or the project developer. And then for the non-payment protection, it would be the lender. Is that correct?
That's correct. I think on the second one, you're able to bond the developer so that the developer is the insured, but the payee is the investor. And I think that's quite exciting because, if the developer goes out of business, then that investor can take receipts of funds.
Great. And we just talked about this a little bit, but I would love if you can dig into it a little bit more, because it sounds like your prepayment protection and the non-payment protection are specifically designed to address the concerns from the banks, the investors, the impact funds. And I would like to hear a little bit more of how these products are actually being used to unlock the financing for carbon projects that might otherwise struggle to raise capital.
Yeah, I mean, if I use maybe another example of, we had a regenerative ag business looking to, working capital challenges, in that they had an offtake agreement in place, strong offtaker who was due to pay them once the credits were delivered. I think it was maybe over a 6 to 12 month period. Now, in any other market, with that sort of security in terms of a third party commitment, you could go and use that invoice and factor that invoice. You could take that to a bank and say, look, I'm due these funds in the next 12 months. Can you advance me the funds for a small charge? And by doing so, help me build working capital that allows me to scale projects, invest in new plants, invest in new facilities. Challenge here in the carbon market is the sort of lack of sophisticated understanding of the market in some cases from banks, or indeed just the sort of capital risk and exposure that they are unwilling to take with a carbon project. We basically work with them to say, well, if something goes wrong, then we will pay you. We'll almost act as that backstop for the developer, that if they don't get paid by that offtaker, then they're unable to pay that loan, be able to pay that facility back. And we can help basically smooth that downside scenario for the bank. And what's interesting is, in converting this from a product perspective into a language that the bank understands or an impact fund understands, it's starting to get them really excited, because, there's capital relief benefits from a Basel III perspective. There is simply deployment capability that they're looking, they've raised funds, but they're looking at the carbon market and struggling to figure out how do they deploy it. Well, we can apply our risk assessment and understanding alongside them, but also then syndicate some of that risk and enable their capital deployment. So I'm really excited by these sort of product advancements, because it's starting to create some standard structures, Jay, that again are familiar to the bank, that you don't have to have the level of knowledge and intimate detail of the carbon markets that we may have, but you'll understand the financing agreement and you'll understand that language and see the value of an insurance policy sitting alongside that. And I do truly believe that if and as when these products start to get some scale, they can be the unlock for deployment of capital into markets.
Right. And given what you said, where, the last couple of years have been, you've gone down the path of educating all of the players and the stakeholders, both you and your peers. And then given the fact that you've got both products that you've had on the market and new products that are coming to market, generally speaking, have you been seeing an increase in demand from investors and developers for these types of protections?
Undoubtedly, there's been increased interest. If I go back to the sophistication of contracts that are now in market, you only have to look at some of the recent public contracts, from like of Symbiosis, or indeed even the Singapore government with their RFP. You're starting to see sophisticated contract language appearing. I think we're still at an education point in terms of, well, how insurance can support in those contracts. That I think a tipping point will come over the next 12 to 24 months, as on the buy side, they start to role model by pushing maybe some of these requirements down to developers. So definitely more interest. We've had more inbound activity over the course of this year than we had for the whole of last year. And I think I'm hopeful, therefore, that it's, we're not a silver bullet by any stretch of the imagination, but I think we can really help play a role as an insurance market to help solve some of the problems that exist in the market.
Well, I'm sure you can. I have no doubt about that. So I want to talk about some of your recent partnerships. I saw that you guys partnered with Apollo to introduce insurance capacity to the market. Why don't you tell me a little bit more about how the partnership came to be and its impact thus far? And if there are any other notable partnerships, you can elaborate.
Yeah, happy to. So yeah, Apollo, Hiscox, Africa Specialty, a number of syndicates. And it goes back to my point around the beauty of being a Lloyd's syndicate is we can get other syndicates like Apollo and Hiscox to sit behind us, trusting in our underwriting of the risk and putting their capital to work to build increased capacity options for the market. They helped us really with a significant opportunity which exists in Corsia. So we designed a very specific product to help with the risks around corresponding adjustments, and with the advent of insurance playing its role in that market, which I think and hope we'll see in the next couple of months from the standards bodies, approval of the private insurance market so that developers can use our products to get Corsia eligibility. Well, again, some of the scale of those projects, one of the project developers we're working with has projects in 10 countries, has a capacity need, in the tens of millions of dollars. We basically priced the product and got other syndicates to sit behind that. And that just gives confidence again back into the market that if you're a project developer and you've got, a pipeline of projects where you're going to be selling credits into the airline market and you need large coverage limits, then we're here to support.
Brilliant. Well, I want to look towards, we're looking towards the present, but also the future, because they're kind of linked, especially in this particular question. You've definitely addressed this with some of the products that you're developing, but what do you feel like still are the key challenges that the industry face in terms of de-risking carbon markets? Like, what do we have to go towards today, but also tomorrow?
Yeah, I think that, clearly the voluntary market has had its challenges over the last couple of years. Constant question I'm asking my team, I'm asking out in the market is where is demand going to come from?
Yeah.
Because if no one's buying credits, then business standpoint, our insurance is irrelevant.
Yeah.
And I think we're starting to see, that convergence of compliance and voluntary markets, which I think is exciting from a market perspective and then clearly useful from an insurance perspective, because I think what that will do is start to place, as it's already doing, increased obligations into the voluntary market of the standards and the issues that it needs to resolve. I use the Corsia example because it's quasi-compliant and it's very relevant, and a day doesn't go by where we're not reading an article around where supply and demand might look in the Corsia market. And many developers, the smart ones, are looking at that market to see how can I play a role.
Yeah.
I think what's interesting from a system standpoint, Jay, is that what's happened within Corsia is there's, via ICAO's demands on the voluntary market, what they basically said is there's a risk issue here that you need to deal with. And the issue is around this corresponding adjustment risk. That risk has existed forever. Whether a developer can sell credits outside of a country and a corporate use that credit, but ensure that the country's not using it for their own NDC, that's always existed. But what ICAO said is, well, this double counting risk, we don't want our airlines to have to be concerned by that, have to deal with any of the repercussions of that. We want you, the voluntary carbon market, to put in place mechanisms that ensures that airlines can retire confidently as part of their compliance needs. You need to solve this double counting issue. Well, great. Well, what that's done is created a very clear problem where insurance can play a role. And what we've done over the last 12 months is help the standards bodies. If you look at Bear and Gold standards approvals in November, is the guidelines that they put together. They put together structure, well thought through mechanisms that will allow, if a corresponding adjustment is not made, a developer will have to replace that credit with another Corsia eligible credit. And they can do that by virtue of having an insurance policy that pays them to do that. From a systems standpoint, that just provides much more robust and transparent guidelines and mechanisms and actions that for me have just been really lacking in the carbon market historically. If we look at some of the problems, Jay, when an issue happens, and there's been numerous incidents over the last couple of years, if you look at Sequest, Cookstove developer, overissuance of credits, what fails to happen in the market is action be taken off the back of these instances. And that just degrades confidence. If you're a buyer and you're holding those credits and you look at the market and go, okay, right, something's happened. There's been overcrediting. What's the remedial action that's now going to take place? These projects go on hold. The sort of news dissipates. The sort of noise disappears. People sort of look to pricing to sort of deal with the issue. That's just flawed in so many ways. That carbon has not been stored and action should be taken, either impairment of those credits, removal of those credits. And that's one of the fundamental flaws in the market, is that this sort of course correction of whether the science is advancing and we realize, a ton of carbon is not a ton of carbon anymore, or incidents and bad actors exist in the market. But the market hasn't responded well to those issues, and it's got to get better. And I look at Corsia and I look at that mechanism and go, well, that's evidence that we can come together as a market and deal with these issues in a transparent way that means that integrity can be built.
And as this maturing is happening in terms of a geographic expansion, where do you see the most growth potential for carbon credit insurance?
I mean, we've gravitated towards the African continent predominantly because of the interest in our Corsia eligible product, and also developers there getting smart about thinking about selling into that market and therefore more viable investment opportunities. So, over the course of the last 9 months, been working with a number of those developers. I think we've looked at maybe 70 LOAs over that period, letters of authority. But that's more been driven by future demand. And I think from a geographical perspective, the ASEAN region, you're certainly seeing Singapore, Japan, Australia. What's great, we're seeing the counterpoint to what's happened in elections in the US in November. We're seeing a counterpoint in response to that with recent elections in Canada and Australia. And I think having climate as part of the policy agenda, clearly you and I would both say this is obviously important, but it hasn't necessarily been important in some places. And from a geography perspective, insurance should be helping investments across projects in all areas. But I think the path over the next 12 to 24 months will be, Europe, Africa, and the ASEAN region. We're certainly seeing most of our interest come from those places.
Yeah, that's also in line with what we've been seeing just in terms of market activity and finance flow. So yeah, it's kind of an interesting thing. I breathe a sigh of relief with the Australian and Canadian election results after the beginning of this year. We're always heading in multiple directions, but some pro-green governments in really big influential countries have at least decided to maintain the course for a little bit. And so that's positive.
Exactly. And look, I'm 3 years into the carbon market, but as I talk to veterans, this sort of swing from an opinion standpoint, but also the build and bust of markets, they're all natural developments of markets.
Yeah.
It's easy to think that markets just are linear and that they scale exponentially. If they don't, they build and they get rebuilt, and they build and they get rebuilt. And I'm confident, if you look at what's been put in place in carbon markets more broadly, voluntary and compliance, that we're moving in the right direction. Are we moving quick enough? No. Are we deploying enough capital? Absolutely not. But I'm an optimist and a pragmatist, and I think the things that are needed are being put in place. And I share your enthusiasm for some of those recent results.
Yeah. Well, let's see. And so it's crazy to think that we're halfway through May, which gets us close to halfway through the year. And that said, what does the rest of the year look like for you all in 2026?
Big focus on Corsia in developers and intermediaries, and airlines are ready to buy. So what do we need is we need the standards bodies to approve the private insurance market, welcome Oka in, and there are transactions ready to go. So we're focusing a lot of our effort in the near term of just enabling that and making sure that the Veras, the gold standards of the world, have what they need to ensure that we can move forward, because we need to see pockets of demand. And Corsia's a very clear near-term one that I think just broadly the carbon market could build some confidence off the back of. And then secondly, spending a lot of time, I expect to be announcing through the rest of this year, a lot of time with various impact funds and banks as they are getting smart on their ability to use our products to deploy capital. So that's a really exciting space. And I think, we'll see that continue to develop. But from a product portfolio, I think we've got most of what we need for the market. I think this year it's about continuing just to help educate.
We also do quite a bit of work with impact funds. And so it's nice to hear that that is one of your key targets, because it is such an exciting space. I think impact investing it really offers a lot of great advantages. And so if you can do some education and collaboration there, I think that will have tremendous positive impacts down the road, because we always have such a delight working with the impact fund groups.
They've got their shared values, shared alignment, what they're trying to do. I think the carbon markets for a number of them are just new and novel.
Yeah.
And that sort of getting that first deal over the line is difficult for them. So, again, just getting that sort of first of a kind transactions up and out, I think we can be then a catalyst. And it's a close community as well, isn't it, Jay, as you know? So they'll talk to each other.
Absolutely.
And educate and help each other. So any way we can help you and some of the references or connections you have there, happy to follow up as well.
Absolutely. 100%. Well, Chris, I always like to end the episode by infusing a little bit of stoicism. And this one comes from the former slave turned great Stoic Epictetus, who once said that what concerns me is not the way things are, but the way people think things are, which continues to be more relevant as each passing month in 2025 happens. So I modify this, and my question to you is, what do you think is one thing that must be done to change how people think about climate finance?
That's a good one. I'm a quote fan as well. One of the ones I use quite commonly for when I speak to people inside and outside the market is really perfection is the enemy of progress. And I think we get bogged down too often within the carbon market, and more broadly just climate finance, by the strive for perfection.
Yeah.
This need to deal with every eventuality and to take all risk off the table. As I said before, I'm a pragmatist, and it's about, for me, putting solutions in market that move the puck forward, move the ball forward, whichever sport you want to be playing. So we got to start thinking about how do we take pragmatic steps to move forward.
Yeah.
Always my call to arms are, look, we can keep debating the perfection, the utility of that and the utopia, but look, we're not going to solve this crisis if we're still stuck here debating. So we've got to make action and take action. So on the climate finance side, know that there are options here where we can work together, and it will take the collaboration effort, as it has done within other industries, between investors, policymakers, government, and insurance to really help the carbon market scale.
That actually tracks so perfectly for you, because how we started this conversation of saying that you created your company with a thesis and then the thesis was immediately proven wrong is literally the exact definition of like, well, we got to try stuff. And if it doesn't work, it doesn't mean that the whole system's wrong. We just have to try something new and move forward. So you circled that back very perfectly, Chris. I appreciate that.
No problem.
We're football fans, so let's say we got to move the football down the field and then eventually put it in the net.
There you go. Take a shot. If you miss, go and take another shot.
Yeah, that's right. Tap into your Mo Salah.
Exactly.
He misses a lot, but he scores a lot. So there you go. Great. Well, Chris, thank you for taking 40 minutes of your time this week to chat with me. I appreciate all the insights. It sounds like you guys got some great products on the market, and I look forward to promoting the episode and sharing all of the great things that you just said.
Really appreciate your time, Jake. Thanks a lot.
Right on. Take it easy. All right. A massive thanks to Chris for coming on and sharing his sharp insights into the evolving world of carbon credit insurance, as well as the important work Oka is doing to build confidence and unlock capital in the carbon markets. Chris walked us through a lot, from Oka's founding story and product strategy to how insurance is helping developers raise finance, de-risk deals, and bring more institutional capital into climate projects. His clarity on risk, trust, and deal structuring was exactly the kind of perspective this space needs. So once again, thanks to Chris and to everybody else for listening. And I ask, as always, before you go, don't forget to subscribe and leave a review for us on Spotify or Apple Podcasts. If you're on Spotify, tap the bell icon so you never miss an ep. And also, be sure to check out our other podcast episodes and sign up for our weekly newsletter Sliced for updates on climate finance, carbon markets, impact investing, and much, much more. All right, so see you in a month for another climate finance combo. Thanks for listening, and until then, take it easy. This podcast is brought to you by Gordian Strategies.